Hi, I'm Rinde from AskRinde, and welcome to the channel where we help with your foreclosure, income, and credit. So is there a difference between stopping foreclosure over $500,000 versus stopping foreclosure under $500,000? It absolutely is. And I want to share with you some tips and strategies on what to do. So if you're facing foreclosure and your loan is over $500,000, keep watching. So after so many years of helping hundreds of families all across the U.S. stop foreclosure, I've seen a stark difference between homes that are actually had debt of over $500,000 versus those that are under. And I've had a lot of inquiries regarding this particular topic and threshold, so I wanted to do a video to be able to share with those who are facing foreclosure and they have loan amounts that are over $500,000 as to what to do. But before we get started, why $500,000? And that's because the conforming loan amount in the U.S. for most states is $484,350. That means that any loan that's above $484,350 fits into what is called a jumbo loan category. These are loans that have different criteria and they're not part of the regular mortgage market, or loans that can be bought by government insured entities such as Freddie Mac and Fannie Mae. For most average home purchases in the U.S., Freddie Mac and Fannie Mae will actually guarantee and insure all loans that are written up to $484,350. So the lenders that are playing in that world where they're actually lending money to people who are purchasing these homes have a further insurance that they will actually get their money. So that market is really the busiest part and the largest pool of mortgage activity in the U.S. That's where you see people are able to go ahead and buy properties via the FHA. They can use different type of structures to be able to get properties either 3.5% down, 3% down, but it's much more favorable and it's easier for the properties to cycle through because the lenders are abundant, and also when things go awry and there are foreclosures, then the properties are easier to actually get sold off because their price point is lower. So in that world, the lenders actually then are insured not only of getting their money, so should anything go wrong, but also when the servicers go through the process with you in foreclosure, and let's say in your case you are behind, you're trying to work something out with a loss mitigation, and they just seem to be not cooperative. That's because they're very much comfortable in the fact that because of your price point and the market, so to speak, they know that they can take your property back and they can easily sell it off and make a further profit. So I've shared in some of my other videos details regarding how lenders purchase the notes and what the ratios and their percentages are, and that what their interest position will be long term should you go ahead and pay for the property over the 30 or 40-year mortgage period that they're giving you. So you can watch those videos to get more details on those. For the purpose of this video, we're talking about the separation. So that 484 conforming loan limit separates the average mortgage market from the jumbo loan market. I just want to highlight that a jumbo loan starts in less expensive markets at $510,400. And in more expensive markets, they start at $765,600 and up from there. So the process to get these loans are completely different. The lenders that do these loans are far fewer than those that are in the regular average mortgage market. So for example, with the fallout economic that we have going on all around the world, in March, the Mortgage Credit Availability Index, which kind of like gauges lending standards, fell in the average mortgage market 16.9%. But in the jumbo Mackay, it fell 37%. So what that does basically, it shows that lenders are not tightening their grips even further when it comes to lending. So in the jumbo market, it's actually now tightened up. They've pulled in the reins and they've made things more stringent because the risk has gone up because of all the different factors of unemployment, the uncertainty of the real estate market, the uncertainty of price changes, and the uncertainty of what the future holds, what's going to happen as far as long term with some of these industries that have been set up in some of these cities that have held up the real estate market. There are major shifts going on, and the lenders are aware of this. So what they're doing, they're tightening themselves up to be able to protect themselves. So to qualify for a jumbo loan, as you may well know, it's a completely different ballgame. You have to have a credit score of at least 720. You have to look at putting down 20 to 30% when you're going to purchase the property. Some lenders want you to have a year's worth of money seasoning for payments, and then most likely you're going to have a percentage or two more than the average interest rate in order to be able to secure them further. So they take a lot of reins and they take a precaution to be able to lend to people in this market. These are people that they're lending to that have basically a higher track record financially. They're looking to them to be more responsible and have things more together. They don't just give a jumbo loan to anyone. And so that being said, things are one way when you're purchasing, and then as life happens, as we know, things change. You know, you may have had a great job, you may have had a business that was thriving and doing very well, and then a year later, something could have happened, like what the crisis that we're dealing with, like the coronavirus, and the crisis that we're dealing with, the epidemic now. Or it could be something where you lost the business. There was an industry shift. Something could have happened where you got affected, you got hurt, you got sick. Your spouse is someone who was the CEO or the breadwinner or the person who had a great job, and then they're no longer there. They died, or whatever the case is. These things are happening, and life happens in general. So how do you solve this issue? How do you fix this dilemma that's causing you to keep you up at night? Well, the answer lies in one thing, and that is the buyer pool. You see, with the average mortgage market, and when the lender starts foreclosure proceedings and takes the person from lis pendens all the way through the process of foreclosing on the property and taking the property back, there are options for them. They have options because not only are they insured, but then they also have options with these third parties websites such as auction.com, Hubzu. So when the market was really good, it's easy for them to say, yeah, well, we're not going to really work and cooperate with this homeowner. What we're going to do is the minute that we can actually file for insurance on a note, we'll just go ahead and do that. And what we'll do is we'll take the property. We're assured that we'll have the property made available through one of these third party websites, and one of these investors will pick them up. So people are rushing and biting at the bit to be able to buy properties in that price range, less than conforming loan limit. Now, switch over to our loan limit, what we're talking about with jumbo loans, that's a totally different ballgame. There are a few players in that game. Just like there are a few lenders in that world and in mortgage lending, there are a few buyers that are in that price range in order to be able to take those properties and do what needs to be done. Some of these properties need work. Some of these properties need complete rehab done to them. And when you're playing at that level, the buyers are either going to be buyers that will be staying in the property, or they'll be high-level investors, people who are playing in markets that generally are higher, and obviously they're looking to make a profit. The lenders know all of this. So the lenders are looking at the buyer pool factor, and they always are looking at that specifically to hedge their risk when it comes to your loan and your setup that you have with them, because again, all they have was assurances that you had a year. But what happens if you own the property 5 years, 6 years, and then it happened? You were fine, everything was okay, but then you have a crisis like this that completely shifted your industry. So now they're dealing with that now, and now they have to figure out, in taking you through the process of foreclosure, whether, regardless of their rights, what they can or can't do. So what I want to share is that we have to keep this in mind, that you have to also factor in and check off some of the things that the lender is checking off. And they're looking at things from an aspect of what's happening nationally, where the unemployment now is at 30 million. And a good majority of those people are 50 and over. So it's been proven statistically that people who are 50 and over have a harder time of getting reemployment. And if they do, it takes longer. So for example, if the foreclosure proceedings and you stop making payments this year, that will take longer for the person to be in the position to either reinstate the mortgage or basically start to make payment with whatever workout the bank gives them. So these are all factors that we have to consider when we're looking at the lender's position and that outlook on the buyer pool. The whole focus with jumbo loans is the buyer pool, because what happens basically is the buyer pool is what's going to solve the issue in the jumbo loan market. And when you are in that position, you're trying to figure out either how to keep your property. You're looking at some of the same factors that we deal with in the average mortgage market, where you'll be looking to do either a loan modification or you'll be looking to work out some sort of loss mitigation. Those things don't change, just like the lender's rights don't change as far as foreclosure proceedings. However, the risk and the hedging and the negotiation is totally different, because this can be a longer term situation. Here's an example of what I mean by that. So you have one property here that's over $500,000, and they're entitled, the bank is entitled to go ahead and take them through for foreclosure proceedings, and they're at the point where they have an auction date. But look at the dates and the postponements here. Look at when it started, and look how long it's been until this person has actually taken to foreclosure. Now I'm going to show you another one that is actually in the average mortgage market, less than $484,500, And let's see how long that process takes. So as you can see here, obviously, there are people who in the average mortgage market that obviously can extend this further. Maybe they file a bankruptcy, or maybe they work with us and we've shown them how to actually extend their property and avoid having their property taken out foreclosure. But on average, you'll see that the properties that are over $500,000 run longer. And there's a reason for that, because the buyer pool is very small in this market, especially with the jumbo Mackay dropping to 37% and they're tightening standards. There are fewer buyers coming out and purchasing these properties, especially when prices start to drop. That's where the big problem is. Not so much in the less expensive market, but in the higher price market is even a bigger problem. As it's harder for the buyers to be able to get loans, to be able to purchase these properties, the lenders find a harder time foreclosing on you. Because the thing about it is that they have to take the property back, go through the entire process, and there has to be an end buyer. Somebody's got to be waiting at the end of that tunnel, that hole, to be able to receive and take the property off their hands. So they're looking at all those factors, because with what you have a lot of unemployment, and you have a trickle effect or a cascading effect economically, where real estate prices start to drop. As inventory goes up, the prices start to slowly decline. Now, in some markets, they're still hot, but generally, for the most part in the U.S., most of the market is going to be not only having a correction, but has been waiting on a correction. Some of these overpriced, high-priced markets, these so-called high-ticket markets like San Francisco, etc., these are markets that needed a correction. They were too hot. They needed to start to come down. And so with that correction happening, it spells trouble for these lenders in the jumbo loan market. And what they'll be looking to do, more so with you, is to listen. So there's one key strategy that we use when we're stopping foreclosures over $500,000. And I've done a webinar, and I would like to invite you to watch the free webinar by clicking the link below. I give you some insight strategies on what to do and how to maneuver and how we deal with the bank, and what we do specifically with this type of loan and this type of lender when it comes time to face the music and deal with them to stop your foreclosure. In addition to that, as you watch the webinar and after you actually are done with it, I would like you to send me an email and let me know your situation so that we can actually look into it and see how we can help you. In addition to that, please download my free Stop Foreclosure Guide below by clicking the link below. And at the end of it, the last page will be a form. You can fill out that information and it will be sent over to us, and I'll be able to look through your situation to be able to give you an insight on what to do next. So I look forward to seeing you guys on the next video. I thank you so much for watching. Until next time, thank you for watching.